Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing CrowdStrike stock so we can determine if it's a buy or a sell. CrowdStrike is a cybersecurity technology company. It provides cloud workload and endpoint security, threat intelligence, and cyber attack response services. The company has been involved in investigations of several high-profile cyber attacks, including the 2014 Sony Pictures hack, the 2015 and 2016 cyber attacks on the Democratic National Committee, and the 2016 email leak involving the Democratic National Committee. The company is headquartered in Austin, Texas, and was founded in 2011. Let's get started with the model. This is a large cap company, 37 billion market cap. They're trading at $154 a share, and they have 237 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow looks really good. It goes up each year from 300 million to 440 million to 675 million to almost 750 million in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. It appears they have lots of write-downs because they have negative net income each year. When a company has positive free cash flow and negative net income, it's likely there's a lot of write-offs. Goodwill impairment, asset impairment, things like that. It also could be a sign they're paying a lot in stock-based compensation. That brings down a company's net income, but it's a non-cash item, so it doesn't affect cash flow. Revenue is a sales for the company, and that looks really good, growing from 900 million to 1.5 billion to 2.2 billion to almost 2.5 billion in the trailing 12 months. Here's their most recent income statement, the 3 months ending 4/30/2023 versus the 3 months ending 4/30/2022. Revenue is up from $500 million to almost 700 million. Let me give you a breakdown of the revenue by location. 69% of their revenue is in the US, 474 million. 15%, a little over 100 million in Europe, Middle East, and Africa. 72 million in Asia Pacific, that's 10% of their revenue. And 41 million in other countries, that's 6% of their revenue. Their revenue went up in each category, but it increased the least in the US. You could tell this because their revenue percent went down from 71% last year to 69%. 650 million of their revenue comes from subscriptions, 41 million from professional services. And that did go up in both categories. Subscription revenue is fees for their Falcon platform. That's their main platform. They also have additional cloud modules that are supported by their cloud platform. And when they sign up a new customer, they usually have an agreement of 1 to 3 years. And the revenue is recognized when it's earned. So if somebody pays 3 years up front, CrowdStrike puts that onto the balance sheet as unearned revenue, which is a liability. Then each month the customer uses the service, they remove a portion of the liability off their balance sheet and book it as revenue onto the income statement. Which is this sentence here, I didn't even notice. Because the majority of our subscription customers are billed up front, we have recorded significant deferred revenue. Deferred revenue, unearned revenue, it's the same thing. It's a liability in the balance sheet. Companies that sell gift cards like Starbucks have a ton of unearned revenue because they can't book the revenue until the person uses the gift card. Professional services, this is incident response and proactive services, forensic and malware, and attribution analysis. Professional services are sold separately from their Falcon platform. Although most customers do get a Falcon subscription once their professional services arrangement is complete. That's of course what you want. You want to get them on subscriptions, recurring revenue. That's the goal of any company. Professional services are available through hourly rate and fixed fee contracts, one-time and ongoing arrangements, and retainer-based agreements. Because I think it's important to really understand what's on the income statement, not just look at the numbers and say, oh, it went up, that's good. If we could understand what the numbers are, we could be better investors. In order to generate this 650 million of revenue, they spent 142 million. Really good margins. In order to generate the 41 million of professional services revenue, They spent $27 million. Not that great margins. You can see subscription margins are well over 50%. Professional services are well under 50%. So total cost of revenue is $169 million. That's against $700 million of revenue. Because there's less work for subscriptions. You just have a platform that people use. Of course, you have to maintain it. It's really just recurring revenue. Professional services, you have to spend a lot more time. Let's see what the company says about their cost of revenue. For subscription revenue, these are costs related to hosting our cloud-based Falcon platform in data centers, amortization of our capitalized internal use software. Let me know in the comments if you don't know what any of this stuff is, and I can explain further. Employee-related costs such as salaries and bonuses, stock-based compensation, benefits costs associated with our operations and support personnel, software license fees, depreciation of property and equipment, amortization of acquired intangibles, and an allocated portion of facilities and admin costs. As new customers subscribe to our platform, our cost of revenue will increase due to greater cloud hosting costs related to powering new cloud modules and the incremental costs for storing additional data collected for such cloud modules, and of course, employee-related costs. You may need more people helping. We intend to continue to invest in additional resources in our cloud platform and our customer support organizations as we grow our business. The level and timing of investment in these areas could affect our cost of revenue in the future. So hopefully as they add more subscribers, their margins improve. But of course their expenses will go up. But hopefully the expenses don't go up as much as their revenue goes up. At least that's the idea with any company. Professional services cost of revenue. This consists, as you probably guessed, of employee-related costs, such as salaries, bonuses, stock-based compensation, also technology, depreciation, and an allocated portion of facilities and admin costs. So their gross profit is up from $360 million to $520 million. But you really can't tell, did they improve? I know monetarily they improved, but did their margins improve? That's important. We can easily calculate that. Gross profit, $523,350. Revenue, $692,580. So their gross margins are 76%. Now last year, gross profit of $361,002. Revenue, $487,834. 74%, so their margins are improving, which is what you want to see. In 2023, they converted 76% of their revenue into gross profit. So they converted 76% of the $700 million into gross profit, which is $523 million. In 2022, they converted 74% of their revenue into gross profit. This is just for one quarter. It's not for the whole year. It's for the 3 months ending April 30th. Now let's look at their operating expenses. Marketing is up from $190 million to $280 million. You wouldn't think a company like this has to spend a lot of money on marketing, but obviously they do. So if you annualize this number, it's well over $1 billion in marketing. That's a lot of money. Because you don't really see CrowdStrike commercials. It's not like Coca-Cola or Subway, but they do certain types of marketing that is not as visible as a big company like Coca-Cola. Let's see what the 10Q says. Sales and marketing is employee-related expenses, salaries, commissions, bonuses. It also includes stock-based compensation, expenses related to our Falcon customer conference. They probably go to big conferences and send employees there. The travel expense, the expense to stay at the hotels. They might take clients out for dinner at the conference. That's all part of marketing expense. And other marketing events. Amortization of acquired intangibles. That means they acquired another company or just acquired intangible assets from another company, and they have to amortize those assets over its useful life. So if a salesperson sells a subscription to a customer or upsells a customer to a higher subscription, that employee receives a commission. That's what this sentence is. And those commissions are capitalized and amortized over the estimated customer life. So it's carried on the balance sheet and then amortized onto the income statement. So if the employee received $10,000 in commissions, and let's just make it easier, the customer signed a 10-month contract. CrowdStrike would put $10,000 of commissions on the balance sheet and each month pass through a $1,000 expense onto the income statement. We also capitalize and amortize any expenses paid for the renewal of a subscription over the term of the renewal. We expect sales and marketing expenses to increase in dollar amounts as we continue to make significant investments in our sales and marketing organization to drive additional revenue, further penetrate the market, and expand our global customer base. However, we anticipate sales and marketing expenses to decrease as a percent of our total revenue over time. Even though the dollar amount of sales and marketing goes up, it's not going to go up as fast as the growth in revenue. Although our sales and marketing expenses may fluctuate as a percent of our total revenue from period to period, depending on the timing of these expenses. Let's do the analysis right now. You should look at all the numbers as a percent of revenue to see if they're increasing at a faster or slower pace. Revenue is right here. That's a $692,487 million. Let's put in the marketing, 281,107, and last year 193,532. So it's actually going up. Sales and marketing last year was 40% of revenue. This year it's 41% of revenue. It could be a timing thing. You should look at it over a long-term basis. If it continues to go up on a long-term basis, that is a concern. Because if it keeps going up, eventually your marketing would be higher than your revenue. It has to come down at some point. R&D, $123 million compared to $179 million. Let's see what they say about R&D expenses. It's mainly employee-related expenses such as salaries and bonuses, stock-based compensation, consulting expenses related to design, development, testing, and enhancements of our subscription services. Our cloud platform is software-driven, and our R&D teams employ software engineers in the design and the related development, testing, certification, and support of these solutions. They have the same sentence as before. We expect R&D to increase in dollar amount, but decrease as a percent of our total revenue. Let's look at their R&D as a percent of revenue. So for 2023, it's 179,065, and last year it's 123,399. So R&D is higher this year as a percent of revenue. Last year, 25% of their revenue went to R&D. They spent $123 million in R&D, revenue of $487 million. This year, it's 26%. So that's not ideal, but at some point, you would expect their R&D as a percent of revenue would decline. General and administrative expenses, $68 million to $83 million. G&A expenses consist of employee-related expenses such as salaries, bonuses, stock-based compensation, and related expenses for our executive, finance, human resources, and legal organizations. The salaries for the executives and their bonuses, that's all in general and administrative. In addition, G&A expenses include outside legal, accounting, and other professional fees. Let's look at general and admin as a percent of revenue. 82634, 67954. So that has gone down. Last year it was 14% of revenue. This year it's 12%. That's what you would like to see. When the percent goes down, that means their margins go up. They had a loss from operations of $20 million. Last year was $24 million. The way to calculate operating loss, it's gross profit minus operating expenses. So gross profit of $523 million minus expenses of $542 million. So they have a loss in operations of $20 million. And below that are interest expense, interest to income, other income and expenses, and of course taxes. They spent almost the same amount in interest expense, $6.4 million. Last year was $6.3 million. They do have a lot of interest income coming in, $30 million, a lot more than last year, $1.5 million, and other of $230,000. So their income before taxes is $5 million, taxes of $4.4 million, so their net income is $500,000. It is positive, which is good. Last year was negative, and probably every quarter it's been negative. I'm not sure if this is their first positive net income quarter, but it might be. Net income attributable to non-controlling interest, $8 million. Net income for CrowdStrike is $491 million. Let's see what they say in a 10Q about all these expenses. The interest expense of $6.4 million. That's amortization of debt issuance costs, contractual interest expense for our senior notes issued in January 2021, and amortization of debt issuance costs on our secured revolving credit facility. The $30 million of interest income, that's mainly income earned on our cash and cash equivalents and short-term investments. So they have a lot more cash now than they did last year. Other income of $230,000, gains and losses on strategic investments, and foreign currency transaction gains and losses. Their earnings per share are between 0 and half a penny because it rounds down to 0. So it could be like 1/3 of a penny, for instance. Last year, their EPS was negative 14 cents. They have 5 million more shares outstanding this year than last year. We can calculate the EPS to find the exact amount. To calculate the EPS, we take their net income, 491, shares outstanding, 236,414, 491 over 236,414. You could see it's 2/1000ths of a penny, so it rounds to 0. If you do last year, negative 31523, 231179, it's negative 0.136 cents, and that's rounded to negative 14 cents, since that's a 6, which is above 5, so it rounds up. I like to look at operating cash flow. That converts net income into cash. So even though they reported an accounting profit of only $500,000, they actually generated over $300 million of cash flow. Last year, they reported an accounting loss of $30 million, but generated $215 million of cash flow. It's because they pay so much out in stock-based compensation, which is a non-cash item, and that gets added back here on the statement of cash flows. Let's look at the capital structure. $1.6 billion of equity, $800 million of debt. They're 67% equity, 33% debt. And they could pay off all the debt with the cash on their balance sheet and still have $2.1 billion of cash left over. I gave them a WACC of 8%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $37 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $32 billion. We divide that by 237 million shares. And we get a calculated stock price of $137. They're trading at $154, so they're trading at a 13% premium. It's a sell according to the model. Simply Wall Street is in the other direction. They're at $217. They say the stock is 29% undervalued. 34 analysts priced this stock, and the average price target is $174. The low is $128. The high is $235. So that's quite a spread. Another 42 analysts priced this stock, and the average price target is $173. They say the stock is 12% undervalued. This is where the stock has been trading since they IPO'd in 2019. Its lowest point ever was right when COVID hit. It is hard to tell on this chart, but it looks like it got down to below $10. Then it had a crazy run up to almost $300. That was at the end of 2021. It never hit that high again. It did come down to below $100 in the very beginning of 2023. It has come up 50% since the bottom, but it's trading about 50% lower than its all-time high. There are 144 companies in the same industry as CrowdStrike. If they have a number in red, they're worse than the median. If they have a number in blue, they're better than the median. They spent $280 million CapEx, which is about the average. They have a good debt to equity ratio. For every dollar of equity, they have 50 cents of debt. They generate a little more free cash flow than the average company. They rank 9th in market cap at $36 billion. The average is $27 billion. Their price multiples are worse than average in each category. They generated $2.5 billion of revenue, a little less than the average. They recently went public, so we can't look at their 5-year annual revenue growth rate. We don't have the information. So to summarize, I have them trading at a 13% premium. They've been around 12 years. I do really like the company and what they do. The stock is a bit volatile, but it looks like it could be at a good entry point since it's trading about 50% lower than its all-time high. I rank their free cash flow 6 out of 10, their revenue 7 out of 10, and their ratios 3 out of 10. Let me know what you think. Give the video a like, subscribe, or comment below. If you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.